Hello again. I'm sure you all realised my error in time zone as we finished the last session, but I'm sure you've all rejoined at the correct time. So in this session, we have a paper on short selling. The paper is titled Strategic Trading as a Response to Short Sellers. The authors of the paper are Marco DiMaggio, Francesco Franzoni, Massimo Massa, and Roberto Tubaldi. And our presenter is Francesco. Francesco is a professor of finance at USI Lugano. So I'll hand over to him to start his presentation.
Okay, so thank you very much, Carol, and thank you to the organizers for having our paper on the program. So let me share the screen. Okay, so as Carol said, this paper is joint work with Marco DiMaggio from HBS, Massimo Massa from INSEAD, and Roberto Tubaldi, who's here in Lugano, actually sitting in front of me right now, he will be here to help me with the tough questions. So this paper is an empirical study of the interaction between short sellers and other market participants. In particular, we look at how other market participants respond in their trading behavior to the presence of short sellers in the market, and the implication that this might have for impounding of information into prices. So let me start with the motivation. So in finance, there's a large body of literature arguing that short selling is beneficial for price efficiency. There are theory papers making this point, and also there's abundant empirical evidence supporting this view. However, regulators do not seem to at least fully embrace this point of view, given that they restrict short selling. For example, in the United States, the SEC imposes this modified uptick rule, and periodically, especially during times of crisis, and we have experienced this during this recent COVID crisis, bans are imposed. This time was Europe, but during the Great Financial Crisis, it was also in the United States. This more skeptical view of the impact of short selling on financial markets has some theoretical support in a paper by Goldstein and Grumbel. These authors argue that short sellers can successfully manipulate prices in case firms make inference from prices for their investment behavior. So this consideration suggests that the debate on the effects of short selling is still ongoing. And this is also testified by a recent paper by Enriquez and Pagano coming out during the recent crisis, suggesting that arguing in favor of not imposing restrictions to short selling. So here we want to contribute to this debate, and we study a new potential channel for a negative impact of short selling on the efficiency of prices, on the impounding of information into prices. And the channel that we study is the strategic reaction of other market participants to the presence of short seller. In particular, we focus on investors that have positive information on a stock. And the story we tell is very simple. So if some investors have positive information about the stock and they would like to buy this asset, well, if they anticipate that short sellers will push the price down at a later date, well, then it makes sense for them to wait for the price decline and to acquire the asset at a later date. It also makes sense for them to conceal their trades so that to prevent their information from leaking into the market and to prevent short selling from withdrawing from the market. So the conjecture is that positively informed investors will postpone their trading behavior when there are short sellers present in the market for the same assets, and they will try to conceal their trades, for example, by breaking them up and spreading them out across multiple brokers. You see that if positively informed investors trade less aggressively, then their information is less likely to be impounded into the price. And so prices will be less revealing of positive information. So this conjecture that we make finds theoretical underpinning in work by Foster and Viswanathan, where they have a model with differentially informed traders, so traders that receive divergent signals, some positive, some negative signals, and these traders engage in a waiting game. So exactly what I suggested. So they postpone their trade, and so that prices are less revealing of information. For our conjecture to make sense, we need to make a couple of assumptions. So first, short sellers and positively informed investors need to coexist in the market for the same asset. So we need to have investors with different signals trading on the same asset. So this kind of assumption is consistent with theories, both rational, like the Forster-Viswanathan one, and behavioral, like Hong and Stein. So theories that postulate that there exist differentially informed investors. But also in the real world, we find that we think it's plausible to claim that there are investors that receive different signals, given that different type of traders base their actions on different type of models, for example, quantitative or fundamental models, and they receive signals at different frequencies, such as high or low frequency. The second assumption that we need to make is that short selling is observable by other market participants. So other market participants need to condition their actions on the presence of short sellers. And we think that this is also a straightforward assumption, given that information on short selling is spread into the market by data providers, such as Market, we use for this study, or brokers. So if assumptions 1 and 2 make sense, as we believe, then we can go to the data with a testable conjecture. The conjecture that we're going to test is that there is lower impounding of positive informations for stock more exposed to short selling. And the channel that we're going to study is exactly the fact that positively informed investors will delay their trade and will trade less aggressively. Okay. So basically what we are going to do in the paper is to relate measures of price informativeness to trading behavior. Price informativeness and trading behavior, relate them to short selling activity. And so for this reason, we need some exogenous variation in short selling activity. So we obtain this identification by focusing on the Reg-Show experiment, which the SEC ran between 2005 and 2007, when they removed the uptick rule on a randomly selected group of stocks, which were called the pilot stocks. So the uptick rule is a restriction to short selling. So for pilot stocks, short selling was becoming unrestricted. So Wider, Lee, and Werner, in their seminal paper, studied extensively the Reg-Show experiment, and they indeed found that there was an increase of short sale volume on pilot stocks, and in general that short sellers traded more aggressively on these stocks. So we complement their analysis by showing that pilot stocks also experience an increase in short interest, and for that we use higher frequency observations from Market, and also that pilot stocks experience larger price impact, and for that we use TAC data. So all of this suggests that there was more aggressive trading of short sellers and more price impact on pilot stocks. But this evidence is exactly what we need for our conjecture to be plausible, because more aggressive short selling provides the trigger for the strategic behavior of other investors. So there's got to be a negative price pressure for other investors to delay and conceal their trades. Moreover, this evidence established a valid first stage for our analysis. So there's a recent paper by Heath and co-authors that they set out conditions for the possibility of reusing the Reg-Show experiment for other in other contexts. And one of the conditions they set out is that there's a valid phase stage. But this evidence of more aggressive trading established this first stage. Okay, so let me summarize the findings, and then I can take some questions. So the first and the more important finding that we have in the paper is that information impounding before positive earnings announcements decreases when more short sellers are present. So we focus on earnings announcements, and in particular on the period, 2-week period before earnings announcement, because that's when it's most likely that there are diverging points of view on the fundamentals of the assets. So there is more dispersed information in the market. We don't find an effect of short selling on information impounding before negative announcements. And overall, we conclude that this evidence is not inconsistent with the early evidence of improved price efficiency when there is more short selling, because the earlier evidence was found unconditionally, whereas we condition on periods with intense information asymmetry. Actually, prior studies were suggesting that short sellers can improve impounding of information, but especially after the information becomes public, so when it is revealed. So there's a paper by Engelbert, Reed, and Ringenberg making this point. We study a period when information is still private, so it's not being revealed yet. So this is a graphical description of our main result. So in red, you see the price behavior for pilot stocks in the days before the earnings announcement, which occurs on time 0. You see how for pilot stocks, prices approach the final date from below relative to non-pilot stocks, which is the control group. So this suggests that prices approach the fundamental value more slowly, consistent with the lower impounding of information. And these events are the positive earnings announcements that we look at. And so the effect is sizable because overall we find an 18% lower information impounding for these stocks. Then we have other results where we study the channel, so the trading behavior of the other investors. So for the channel for this decreased information impounding. So what we find is that informed investors decrease the speed of their buy trades ahead of positive earnings announcements in stocks with more short selling activity, so the pilot stocks. They also break up their trades across multiple brokers, so evidence of hiding. In particular, they do that by going to brokers that are more peripheral, therefore less likely to interact with other investors and to spread information, and to brokers with whom they traded less in the past. So brokers we call less familiar. And then we make some effort also to rule out alternative interpretations of our evidence. In particular, we tend to rule out the fact that this lower information impounding is the result of a switch of short sellers from liquidity provision to liquidity demand, and also that this less aggressive behavior of the positively informed investors is a result of learning from short sellers, so an updating of their signals. So here is a quick reference to the literature. There's a literature on short selling, very large. In particular, I want to point out the literature that suggests that short selling increases price efficiency. As I said, this is unconditional evidence. We contribute here by bringing conditional evidence, so when information is still private. And then there is also a literature on strategic trading to which we contribute. Okay, so I can stop here in case there are any questions.
No questions yet, so just keep going. Thanks.
Thank you, Carol. Okay, so I'll continue by describing our empirical strategy, in particular, talking about the data. So we identify the behavior of other investors in the market by focusing on institutions that report their transactions to this data set that's called Hagströmer. So Hagströmer has transaction data for mutual funds and hedge funds, about 900 institutions in total. And among these, we identify those that are more active managers, so those that we consider to be the informed managers. And we identify these active managers by looking at how they trade, whether they trade individual stocks as opposed to portfolio trading. So, and then we focus on the period that goes, that is around this Rexroth experiment. So we have a pre-event window that ranges between 2002 and 2005, and then the event window that goes from 2005 to 2007. As I said, we focus on earnings announcements because that's when information is still private, the period before. So we have 32,000 announcements, of which 23,000 are positive surprises. We define surprises relative to the median analyst estimate, and we impose a condition that is also present in Weller, that there is enough information revelation so that the surprises are large enough. Okay, here's our empirical approach. So because we have a treatment and a control group and a pre and post period, we can run a difference in difference analysis. So we regress our variables of interest, which are either price informativeness or trading speed, at the stock event level, where the event is an earnings announcement, on the interaction between this pilot dummy, so the treatment dummy, and the program period. So our interest really is on this beta coefficient. And then we have a set of controls, including stock and time fixed effects. Our standard errors are clustered by stock and time. So as I said, we focus on the 2-week period before the announcement, when this formation is still private and there's high potential for diverging opinions. Okay, let me come to the main evidence. In the main evidence, we focus on price informativeness. So how do we define that? So we look at the total information that is revealed in the event, so in the announcement, in the earnings announcement. So the cumulative abnormal return over the window that goes from 10 days to 1 day after the announcement. And we ask what fraction of this information is impounded before the announcement, that is in the window that goes from -10 to -2. So that's our measure of price informativeness before the announcement. And these are adjusted return relative to standard factors as DGTW do. So we separate between positive and negative earnings announcement, and a priori we expect an effect on positive announcements. That's when investors with positive signals will trade more cautiously. Okay, these are the main results of this diff and diff analysis. So what I'm highlighting here is the interaction, so the coefficient on interaction. You see the coefficient is negative and significant across different specification. And as I anticipated to you, if we relate this -0.07 to the mean of the variable of interest, this is about an 18% decline in price informativeness over this 2-week period. So it's a sizable effect. That's for positive news. Then when we look at negative news, instead we don't find any effect for pilot stocks. So pilot stocks are those for which there is a stronger presence of short sellers. Okay, in the next part of the paper, we studied the channel behind this result on price informativeness. And as I said, we conjecture that the channel is a more cautious trading, so a slowdown in trading speed by positively informed investors. Okay, so for that, we have to define our trading speed measure, which is very similar in spirit to the price informativeness measure. So we look at the total signed volume between -10 and 1 around the announcement. So sign mean either the buy volume or the sell volume. And we ask what fraction of this volume is carried out in the period before the announcement, so -10, -2. And the idea is that if a lower fraction of this volume is carried out before the announcement, it means that these investors are trading more cautiously. So they are slowing down their trading speed. And we look at the volume of all the active informed managers in Hagströmer. And so we separate between buy and sell, and we separate again between positive and negative announcements. So here I give you the results in graphical form. We also have regression tables. So what I'm plotting here is the slope on this interaction between pilot program and pilot stocks, and we cumulate over all the days. So basically here we have the difference, plotted the difference between pilot stocks and non-pilot stocks. And you see there is a significant difference in trading speed between these two groups of stocks, which then, the difference disappears once the information becomes public. And this is again for positive announcements and for buy trades. Okay, so there is a slowdown of buy trades before positive announcements. And in terms of magnitude, the effect is again significant. It's about 10% of reduction in speed. As far as negative news are concerned, we don't find an effect in the speed of trading before negative news. And we don't find also an effect either for buy speed or sell speed. However, one might conjecture that there might be an incentive also to behave strategically on the sell side for negative news. So think about it. So if there are short sellers around and you anticipate they're gonna push the price down and you want to sell because you have a negative signal, well, then it makes sense for you to rush to sell before the short sellers push the price down. So in the whole sample, when we look at all managers, this effect is not there. However, we find this effect when we focus on the restricted sample of the most informed managers, which are hedge funds. There we find a strategic behavior also on the sell side. Then in studying the channel, we also look at how the trades are spread out in the market, in particular, whether investor spread out the trades across multiple brokers. So there is literature to which I contributed suggesting that brokers leak information to the market. And so it makes sense for investors that want to prevent information leakage to use multiple brokers. So the dependent variable in these regressions is a dummy variable suggesting that traders in a stock use more brokers than the median. And again, we find a significant effect on positive news. So it turns out that for pilot stocks during the program period, investors spread out their buy trades across multiple brokers, are more likely to spread out their buy trades across multiple brokers before positive news, and no effect for negative news. Then I will not have time to show the results here, but they are in the paper. We show that they use peripheral brokers, so brokers that are less likely to spread information, and brokers with whom they have not traded in the past. Okay, so let me take some time for ruling out alternative interpretations of our story. In particular, in the first chart I showed to you, you saw that for pilot stocks, there was basically a lower price than for non-pilot stocks, for the control group. So one might conjecture that this lower price is just a consequence of more aggressive trading by short sellers, which indeed took place. So short sellers became more aggressive, so they could push prices farther down relative to the control group. So can this increased price pressure explain our finding? So to address that, we do a calibration exercise. So we calibrate price impact for pilot and non-pilot stocks before and after the implementation of the pilot experiment. And so we calibrate a Kyle model. So this lambda, we estimate it using TAC data. And we interact this lambda with the square root of the short sale volume for all the groups, so pilot and control groups. And then we estimate a diff and diff around the ratio. So what we find is that the diff and diff coefficient is 47 basis points in the window that we care about. But then if we go back to our main result, we find that this 47 basis points is just 1/3 of the lower price, so of the price decline that we observe in that window. So it appears that the price pressure from increased aggressiveness of short selling doesn't seem to be enough to explain the lower price that we observe. The second alternative hypothesis that we explore is a learning hypothesis. So our main conjecture is that investors strategically delay trading in order to profit from price decrease. But one could tell a story where the the positively informed investors, after observing short selling in the markets, they revise their belief downwards. And for that reason, they trade more cautiously. So how do we separate the two stories? Well, by looking at total trading volume. Strategic trading suggests that volume should increase because these positively informed investors can acquire the asset at the lower price. So they want to buy, the price has gone down, is lower, and so they can buy more. On the other hand, if they are learning from short sellers and they change their priors towards negative, then we should observe a decrease in buy volume. So we test what is the effect on total buy volume during the period around the earnings announcement. And what we observe is that actually there is a 7% increase in buy trades and no effect for sell trades. So this is consistent with the strategic trading hypothesis and not consistent with the learning hypothesis. So this concludes my results. So let me just summarize the main findings. So we start from a conjecture inspired by the theory by Foster and Wissenathan. The theory suggesting that differential informed traders may strategically reduce their speed of trading to avoid dissipating their information rents. And this behavior can have implications for information impounding and price efficiency. So consistent with this conjecture, we find that when short sellers are more present in the market, prices become less revealing of positive information ahead of information releases. We also find that other informed investors delay their buy trades and break them up across multiple brokers. A few words about the implications. Well, for the academic literature, the results suggest that short selling does not improve price efficiency in all circumstances, in particular when there is a wide dispersion of private information in the market, such as the period before earnings announcements. For regulation, well, regulators may want to make short selling contingent on the extent of information dispersion across investors and the timing of specific information releases. But we realize that there are practical challenges to this recommendation, especially measuring the extent of information dispersion across investors. And let me conclude by saying that we consider reg show and short selling as a convenient laboratory for testing this type of strategic behavior, but we believe that these results extend to all interactions among investors that receive diverging signals. So this should be studied in future research. So that concludes my presentation. Thank you for your attention.
Thank you very much, Francesco. The discussant for the paper is Björn Hagströmer, who's a professor at the Stockholm University. Before Björn starts, just a reminder to everyone to send through questions on the web chat. And now I'll hand over to Björn.
Thank you very much, Carol. Can you hear me all right?
Yes, you're all good.
Very good. Thanks a lot for having me here, and congratulations to a very nice program. If it's something that academics agree upon, it is about the merit of short selling. I think we have seen from the recent financial crisis that the bans on short selling are not effective. There is lots of academic evidence. The short sell bans do not stop speculation, they do not save the banks, and they are harmful to market quality. Nevertheless, when COVID struck in March, the European regulators quickly turned to their ban buttons again. And now we're seeing preliminary evidence that, again, this was not good for market quality. Then in this last summer, we saw the Wirecard scandal that put the activist short sellers in a very positive light. So that's with that as backdrop, I think this paper is very refreshing, showing us a positive side of, a negative side of short selling on price discovery. So here's an incomplete, but I think representative review of the literature. I picked the empirical papers related to market quality measures. And what we see here is that there's a lot of papers showing that short selling is good for liquidity and it's good for price discovery. And on the negative side, we have very little. But, this is where this paper comes in. So let me go through the story that Francesco has presented here. The idea is that when there are lots of short sellers active in the market and these short sellers trade aggressively, then if you are an privately informed buyer, you can strategically wait out these short sellers and let them push down the prices. And if you trade carefully, you can fly under their radar so that they don't stop their short selling activity. So they can do this in various ways. They can trade slowly. They can postpone their trades. They can split their trades across many different brokers to avoid that the private information is leaking to other investors. And they can avoid central brokers that they have a tendency to leak more of such information. So some of the authors, including Francesco, have done some great work on this relation between institutional investors and their brokers, and focusing on information leakage. So if you haven't seen that, I think you should check that out as well. The consequence then, with respect to market quality, is that the information that these buyers have, when they trade so carefully, it doesn't really trickle down to the prices. So we get a delay in price discovery, and that's the market quality effect that Francesco and his co-authors are focusing on. And the empirical setting where they study this is very carefully chosen. First of all, they focus on earnings announcements and the period preceding the earnings announcement. So they look at the 2 weeks before, where they argue that this is the time when there is the highest potential for disagreement about information and about the fundamental value. So that's their laboratory, but they add to that that they want to study the impact of short selling. So they need an exogenous shock to short selling. And then they use this reg show pilot that the SEC initiated more than 10 years ago in the US market, where they changed the rules for short selling. They relaxed the rules for short selling in a set of stocks that were randomly chosen, and they left another set of stocks untouched. So this becomes a bit like a medical trial where you give the sugar pill to some patients and the medicine that you want to test to other patients. And it's ideal for evaluation, and it has been used a lot to investigate the pros and cons of short selling. I think this is all very carefully thought out, and the empirical investigations of the paper are really thorough. They use lots of data, and all holds up well. When reading the paper, I had various ideas that I could comment on, but then on the next page they preempted most of those comments. So I think that's a sign of a very well written paper. One thing that I would like to zoom in on is this price informativeness measure. And this is also where I think there may be some room for improvement. So I've sketched a figure here to the left, where the white area is shows the time before a news announcement, and the pink area shows the time after the news announcement. And on the y-axis, you have cumulative abnormal returns. So you can think of these curves here as price paths around the earnings announcements. So this blue one is the positive news side. So in anticipation of positive news, there is a tendency that informed buyers are buying the shares and push the price in the direction of the news. And this may be informed not as insiders, it can also be by superior fundamental analysis. So there will be some of this anticipation ahead of the news, but then when the news come to the market, when it's announced, then there's a jump up to a new level of fundamental value, and after that it may be flat. So the price informativeness measure that is at the core of this paper is interested in how much of the news is discovered ahead of the announcement. So they take as the base the total news from 2 weeks before until the news announcement, and they're interested in how large is this in relation to that. And this metric is closely related to a measure used by Brian Weller in a paper from a couple of years ago, where he was interested in the size of the surprise at the time of the earnings announcement. So that's it's very closely related, but the event window is differently specified. So he considered 1 month for the before period, and he considered 2 days after. I think the authors could elaborate a bit upon on how they chose this the event window, that they chose 2 weeks rather than a month, especially as if you are a careful informed investor, then you might start trading earlier ahead of the news, so it may be relevant to have more time before. And after, it may be a post-earnings announcement drift that is well known, and that could be important for this story as well. And so it would be nice to see that discussion, and also to test other specifications of this really core measure for the paper. The measure, the price informativeness, comes out at around 40%, both for positive news and for negative news. So 40% of the information is revealed ahead of the announcement. And then in the event, they find that there is a 7% reduction in this for the positive news stocks, positive news events in the stocks where short sellers got a relaxed regulation. So it means that rather than this curve that I've sketched here, it may look something like this, that there is less price discovery before the news, and then a greater jump up at the time of the announcement. And you see lots of stars in that table showing statistical significance, but given that there have been so many papers written on this reg show event, this is actually marginal statistical significance, because we should set a higher bar for significance when we use the same event repeatedly. Economically, I think it is significant if we have a mean of 40% roughly, and the event effect is 7 percentage points reduction. So here's a plot of the differential price informativeness, and one of my comments was going to be that it would have been great to see the level price informativeness plotted like this as well. And now Francesco preempted me on that one, because now I saw that he had such a plot in the presentation. I think that should definitely go into the paper as well, to help us to understand what is going on. But my interpretation of this plot is that the reduction here before the event, that means that in the pilot stocks, where the short sellers have more relaxed regulation, there is less of learning ahead of the news announcement. And then at the news announcement, we recover all that. So we come back above zero, showing that the size of the news are similar for the pilot and non-pilot stocks. And then after the announcement, there is some reduction again. So that could be a reduction in the post-earnings announcements drift, or it could be a sign of reversal. So that could perhaps be seen in those level CAR plots. My biggest question to Francesco here is, why the informed buyers are as careful as we see here. So this plot is showing the differential in how they split their trades across the event days. So that this one is falling. That should tell us that in the pilot stocks where there are more short sellers, the informed buyers put less, a smaller fraction of their trade before the news announcement. And I see the point why they would want to fly under the radar a little bit so that the short sellers continue to sell and the informed buyers can buy at lower prices. But still, I would expect them to want to buy ahead of the news announcement. Because if we think about this as private information, that advantage will be there only before the announcement. When the announcement comes, the information becomes public, and they don't have then they don't have an advantage anymore. So I don't really see why they would be this careful. Why don't they trade a bit more aggressively when, especially here in the end, shortly before this news announcement, because that is when they can profit from their information. So to sum up this discussion, I think this is a novel idea and a refreshing take on the short selling impact on market quality. The empirical exercise is impressive in that it's using lots of different databases and carefully chooses the laboratory for the study, and it's all very rigorous. I couldn't find many flaws in that. I also believe in this story about informed buyers hiding behind the aggressively trading short sellers. I think that all makes good sense. I think one thing to improve is this price informativeness measure that is so central to the paper. There should really be more discussion about that and more descriptive statistics and variations considered. Finally, I started with this review of the literature of the merit of short selling and short selling bans. And does this paper then change our overall view of short selling? Probably not. I think it brings a new aspect to the table, that there are circumstances when short selling can be bad for price discovery, but it's still so much evidence on the liquidity and price discovery effects that the overall view is probably not changed. Thank you, Carol. That's all.
Excellent. Thank you very much, Björn. We don't yet have any questions from the audience, so please do send those through if you have any. But that means I'll go straight to Francesco and ask him to briefly comment and respond on Björn's comments.
Yes. So Björn, thank you very much for the thoughtful discussion and the kind words on the paper. So yes, so let me go through your comments. Yes, as you said at the outset, there is strong consensus of short selling, but in the academic profession, but there are also voices out of the choir. That's why in my first slide, I had this paper by Gumbel and Goldstein that actually makes the point convincingly that short sellers can engage in price manipulation. So, this is just an aside to say that, there's some consensus, but it's not unanimous. Then I fully agree with you and with other readers of the paper that we need to show robustness of our price informative measures. It's a fair point, and we are currently working on extending the window over which we measure it, different windows in which we measure it, but also introducing different measures of price informativeness, for example, focusing on the variance ratios, on measures of synchronicities, and the results, the preliminary results seem to be reassuring. You also commented correctly on the statistical significance. Perhaps we should remove the stars based on the new cutoffs that are possibly the standard in terms of significance. And I'm referring to this, again, a recent paper by Heath and others, where they they compute the new cutoffs for the one should use when using the Hagströmer experiment to account for multiple hypothesis testing. And they put a cutoff around 2.8, which is actually good for us because in most of our tests, we have t-stats that are above this cutoff. So perhaps it's not 3 stars, but one or 2 stars for sure. Yeah, so we are gonna put the plot that I had in the presentation, we are gonna put it in the paper, so we will show the level of prices, the 2 prices, and then you commented on what happens after time 0. It's possibly a correction of some overreaction of these traders that were staying out of the market, and then they go back forcefully into the market, and possibly they cause the price to overreact, and then and then there is a correction that you commented on. And then you raised a valid point on why would trading be careful even on day -1 or even day 0, which is what we observe, so that buyers actually are still behind in pilot stocks on the day when information is revealed. And there, the kind of interpretation I can give you is that even when information is revealed in earnings announcement, it takes time to process this information. And the prior evidence that was citing that short sellers contribute to processing public information would suggest that even when information is revealed, the information is not completely clear to the market. So it might still make sense for investors that have a signal to keep that signal hidden. And then just to conclude, with your question, so should we change our overall view on the impact of short selling? Well, I agree with you, probably not as far as the overall view is concerned, but academic research is about digging out details and corners that were not previously studied, and we focus on a situation that was not previously studied, so a situation when the information is not revealed yet. And in that context, we point out what we think is novel evidence about the slowdown in information impounding as a result of strategic behavior. So thank you very much, Björn.
Great. Thank you, Francesco. We actually have a question from the audience now. Michael Schneider. He says, congratulations on a very interesting paper. I was wondering whether you've thought about ways that your findings could potentially be biased by using Anserno data, which captures only some actors in the market, and whether you could control for actual shorting activity in a stock via stock loans, public shorting, so on.
Okay, so thank you very much. So there is extensive literature to which I've contributed using Anserno data. Is a kind of an established data set for studying institutional transactions. And in these prior papers, authors have gone to great lengths in showing that the institutions in Anserno provide an unbiased picture of what is actually the behavior of institutions at large. So Anserno is not such a small fraction of the market. Actually, on some days, Anserno institutions generate up to 20% of the volume that you can observe. So it's a significant fraction, and under many respects, it represents a representative sample. Then you also asked about controlling for short interest. We could control for that. We did. It didn't make a difference, but really because we have these random assignments of stocks in this controlled experiment, we have the luxury that we can use just this assignment dummy for measuring short selling.
Great, thank you. So I have a comment and then I guess an observation of the research in this space, and then also a question for you. So regulators are often very reluctant to do pilots in the way the SEC tend to do. They did it with Red Show, they did it with the recent tick size pilot. But from the academic perspective, it gives us a very nice experiment in order to test events. I understand regulators are reluctant because it imposes additional costs on the market and so on, but it does give us much greater clarity on how particular market structures impact the market. And so that provides us with a very valuable tool. And we've seen with the Reg Show data, we've seen dozens of papers looking at various aspects of the market using that event, which I guess attests to that observation. But my question is, and perhaps the obvious question, this is now a pretty old event, although it's a very nice event to study things. Given how market structure has evolved in the time since then, what speculation might you make about how market structure has maybe changed these results, or whether you still think you'd observe the same result if you were to be able to redo this test today?
So thank you, Carol, for the question. I agree with you that as researchers, we would welcome more of these experiments. We make our lives much easier. We would fight less with one another about identification. Yes, the structure of the market has changed. Possibly we see more algorithmic trading, more high-frequency trading. So I can only speculate here. I'm out on a limb. I think that because of this more algorithmic trading, it's possible that short sellers have just become even more aggressive, and there is and also there's more possibilities for other investors in the market to make inference of information. So there's just algorithms out there trying to study order flow to make inference about what other traders are doing. So this would suggest that strategic behavior in the market has only become more important. So my hope is that these results would still be relevant when applied to more recent data.
Okay, great. So we have a question from PK Jain from Memphis, perhaps an avenue for bringing the issue to more recent data. He says, do you find similar patterns around Rule 201 uptick rule and opposite patterns around the short sale bands? Adding those will perhaps make the paper even more convincing. I'm guessing you probably haven't looked at those events?
No, we haven't, but that's a great comment. Thank you.
Okay, terrific. So we don't have any additional questions yet. So
I have a follow-up.
Okay, go for it, Björn.
So regarding this, that the informed buyers actually buy a substantial amount after the news announcement, would you be able to see in your data if that is ex post rational, in the sense that prices move up further later, maybe several days after the announcement, so that to prove that
we could definitely do that. Well, that would be actually consistent with the post-earnings announcement drift. So this delayed price increase that we observed, would just give evidence that there was underreaction at the time of the event. And I take your question also in terms of measuring whether, from the point of view of these strategic investors, it's advantageous to do that. So what we could do is to actually measure their trade, the profitability of their trades, possibly against a counterfactual. So we could, measure whether they profit from this strategic behavior.
I think that would be cool.
Yeah, thanks.
Excellent, thank you. So we'll wrap things up there. So let me thank again Francesco Franzoni for the presentation and Björn Hagströmer for the discussion. We'll take a break now and we'll start back again with the final session for the conference at 1 o'clock. So we'll see you then.
Thanks a lot, Carol.
Thank you, Carol.